Conventional wisdom tells us lower interest rates are good for the economy and for the stock market. After all, it means cheaper loans, more spending, more investment. Consumers will spend more, feeling that perhaps they can finally afford to buy that new house or dream car. Simultaneously, businesses benefit from reduced financing costs, enabling them to invest in growth opportunities, expand operations, and enhance profitability. These factors combined can lead to a rise in stock prices, reflecting the market's optimism about future earnings. So, when central banks cut interest rates, that should be good news for the markets. But what if I told you that the stock market often falls right after a rate cut? Doesn't that sound backward? Welcome to the paradox of monetary policy. In this video, we'll break down what interest rates really mean, what a Fed pivot is, and why markets behave the way they do, even when logic suggests otherwise. Let's start with the basics. An interest rate is simply the cost you pay to borrow money. One important type of interest rate is the federal funds rate, a short-term rate that banks charge each other for overnight loans. This rate is set by the nation's central bank and serves as a benchmark for many other interest rates throughout the economy. When the central bank adjusts the federal funds rate, it affects borrowing costs for everything from mortgages to business loans, helping to guide the economy towards specific goals. So why do central banks manipulate this rate? Simple. To control inflation, stimulate economic growth, support employment, or prevent recession. If inflation is running hot or economy rapidly growth, the central banks raise rates. Higher rates make borrowing more expensive, which tends to slow down consumer spending and business investment, helping to cool inflation and stabilize prices. Let's now talk about something called the Fed pivot. This is when the Federal Reserve, the central bank of the United States, changes direction, shifting from increasing interest rates to lowering them. In other words, they stop trying to slow the economy down and start trying to speed it up. At first glance, this sounds like great news. The Fed sees the economy slowing, so it's stepping in to save the day, right? Here's the paradox. The stock market often falls right after a Fed pivot. Why? Because markets interpret that pivot as a sign that something might be going wrong. Investors start to worry that the economy could be slowing down, that companies might earn less money, or that unemployment could rise. In short, the rate cut isn't seen as a boost, it's seen as a warning. The legendary investor and founder of the hedge fund Bridgewater, Ray Dalio, highlights that the market is not the economy, but the market often sniffs out the future of the economy better than any forecast. For example, in 2007, the Fed started cutting rates in September. The S&P 500 peaked in October, and then plunged over 50% in the next year and a half. And only on December 2008, when the stock market was already near its bottom, the National Bureau of Economic Research announced that the U.S. economy had entered a recession in December 2007. Earlier, we mentioned that cutting interest rates can boost consumption by making borrowing more affordable. However, it's crucial to understand the context in which these cuts occur. When the Fed cuts rates proactively during stable economic conditions, it can lead to increased consumer spending and business investment, positively impacting the stock market. Conversely, if the Fed cuts rates in response to economic distress, it may signal underlying problems, leading to market uncertainty and potential declines. It can be observed on S&P 500 historical prices, which reacted differently on rate cuts. For instance, the research from Charles Schwab shows that in 12 out of 14 rate cut cycles since 1929, the S&P 500 posted positive returns in the following 12 months, especially when cuts were made to support growth rather than in response to a crisis. However, during the 2001 and 2007 rate cuts, which were responses to economic downturns, the S&P 500 experienced declines of 13% and 17.6%, respectively, in the subsequent year. So, where do things stand right now? The Federal Reserve has held rates steady for months, sitting between 4.25% and 4.50%. Inflation has come down, but not enough for the Fed to act quickly. Markets are betting on a couple of small cuts later this year, but the Fed is still waiting for clearer signs. Meanwhile, major global central banks have already started easing. The European Central Bank has made multiple cuts since mid-2024 as Eurozone growth struggles to gain momentum. The Bank of England has also been cutting gradually, trying to balance sluggish economic growth with still high wage inflation. The Swiss National Bank was actually the first major central bank to pivot, starting its rate cuts in early 2024 in response to low inflation and a strong franc. The Bank of Japan has paused after exiting negative interest rates, keeping policy steady while watching inflation trends unfold. So, what happens if the Fed makes a move? If it raises rates, financial conditions could tighten quickly. Borrowing becomes more expensive, growth slows, and markets may pull back. If it cuts rates, it might give the economy a boost, but it could also spark concern that something's wrong under the surface. And if the Fed holds steady, investors are left in a state of uncertainty, reacting to every data point, trying to guess what's next. In today's global economy, even a small shift in policy, one way or the other, can send shockwaves through markets worldwide. Interest rates aren't just policies, they're signals. When the Fed pivots, it's not always a good sign. Sometimes it's a response to weakness. Yes, rate cuts can spark a rebound, but they can also be the calm before a storm. That's why understanding why the Fed is acting is more important than just knowing what it did. So the next time you see a headline announcing a rate cut, don't just react. Pause for a while. Ask yourself, what's the real message? What's the Fed not saying out loud? Think about it, and then tell us what you think. Will the next pivot lead us to recovery or reveal a recession that's already begun? Like, subscribe, and drop your thoughts in the comments. The market listens to the Fed, but smart investors listen to the story behind the move. See you in the next video.